Good Monday. This is Jay Brew, co-chairman of Seafried and Brew. We want to talk today about event triggers. At Seafried and Brew, we believe that event triggers should be incorporated into your capital plan. Event triggers put into your strategic plan so that both from an internal and an external perspective, the event triggers let you know if something is happening that promotes discussion and maybe change in terms of how you look at your strategic plan or capital plan. So as we look at event triggers, say for instance an internal one might be if there's a certain percentage increase in non-performing loans. An exterior one might be, let's say, that the recession threat index that we talked about last week goes up to a certain degree. So we can look at these event triggers and have them laid out and reported to us on a quarterly or more often type basis in order for us not to let things get away too far. And today what I want to talk about are event triggers based upon the balance sheet. Because if you saw last week's webcast, as we looked at the economy definitely slowing in here, a question of whether or not we're going to go into another recession, that suddenly the balance sheet takes on a different light. As we've talked about before, we've had margin compression. And as we see this continue with interest rates perhaps remaining lower longer term, even as long as what the Fed is saying through 2014, that we don't want the balance sheet to basically continue to compress or limit the compression of the net interest margin. So as we think about it, is that what can we do with the balance sheet? Many bankers complain out there that they have too much cash and they're scared to go out on the yield curve with that cash, especially when you look at, say, like 15-year mortgage backs yielding about a 1.6%. You sit there and say, gee whiz, should I take that risk and go out longer on the yield curve? And then you look at it from the standpoint, well, that cash is at 0.25 on an overnight basis. And I'm losing earnings because of having that cash, yet I look at this risk. So when we look at it is that you should be able to go out on the yield curve. You should be able to go out and buy longer term municipal bonds in here, for instance. You should be able to go and buy mortgage-backed securities. Because if we set up event triggers that then at some point in time, if interest rates do start to move up, there's a warning sign given and we can take gains on some parts of the investment portfolio, maybe losses on other parts coming back into cash. So with that type of strategy, you can think of really being able to increase your earnings here at a time when we're not sure exactly which way rates are going, but with the 10-year dropping down into the 1.4% zone in here today, that it doesn't look like rates are heading up for the foreseeable future. So what can we do in terms of putting this together? And we want to talk next week about a pure strategy using event triggers and how we can put that into place. Have a good week. This is Jay Brew, co-chairman of Seafried and Brew.